Welcome to the Real Estate 401k Show. Here are your hosts, Ryan Gertis, Mike Weinstein, and Justin Frederick, helping you build a legacy of wealth through real estate. Powered by the Recon Group at West USA and the Frederick team with Fairway Mortgage. NMLS number 625918.
All right, Justin. Well, for those of you who don't know, this is Justin Frederick from the Frederick team at Fairway Independent Mortgage. He is our resident loan officer expert, knows just about everything that there is when it comes down to mortgages, and the person, our go-to guy when any of our clients, any of our followers want to talk mortgages, want to talk about getting qualified. You are going to be on the phone with Justin, and in addition, does the mortgages for my family. So I say all that because I want to talk a little bit about mortgages, and we know that there's a variety of different loan types, but the basics going to be VA, FHA, conventional. But then we keep hearing this term about, because it changes all the time, and oftentimes actually you can get a better interest rate, but we hear this term jumbo loan or jumbo package. Give us a breakdown of what that means and who is it for?
All right, so there's loan limits set for counties and for the United States, and those loan limits go up to a certain amount. Currently, it's at $726,200. Now, anything above,
and that's for Maricopa County.
That's Maricopa County,
and that's for a conventional loan, right?
Correct. Now, there's high balance areas, but we're not going to get into that. That's not Maricopa County, and those areas depend on where you're at too. But those are your conventional loan limits. Anything above that, if you need a loan above that number, you have to get a jumbo loan. Now, jumbo loans are private money that different investors, different banks are offering. So they get to make up their own guidelines.
Their own rules.
Correct.
He who's got the gold.
That's right. So it's not just as simple as a conventional loan. This is the set guidelines for conventional loans. Each one of them have their own rules. Each one of them have their own caveats. Each one of them have their own downfalls, if you will, on why I wouldn't use them in certain situations. But you got to know those products, and there's tons of products. And that's why I'm at Fairway, because we have the most amount of jumbo loans that I've seen with my research on where I was looking at going to use for those products. And some of them require 5% down. Some of them require 20% down. Some of them require 30% down. But depending on what some of them don't like you if you're self-employed, and they're hitting you hard on interest rate if you're self-employed. Some of them don't want you to own multiple properties. So there's all kinds of different rules when it comes to the jumbo product.
So is it safe to say that they are still piggybacking off of some of the rules and regulations that a traditional Fannie Mae, Freddie Mac guideline would be, or are they truly gone rogue and they've just kind of come up with these things on their own risk assessment?
That's a great question. There's some of the jumbo products will allow us to use Fannie Mae and Freddie Mac's AUS, which stands for Automated Underwriting System. They'll allow us to run it through the automated underwriting system to tell us what we need to get from the borrowers, and it'll say like approved, ineligible due to the balance of the loan. So those products are nice. They're easy to use, and we tend to use those types of products for your simple W-2 employee putting 20% down, or they're retired, they have a fixed income. It's a lot easier in a basic product.
Okay,
if that makes sense.
So let's talk about interest rates for jumbo loans. I think one of the natural assumptions is, okay, if I'm going to get a jumbo product, because I'm buying a house that's $900,000, $1.5 million, whatever the case is, I think for some people they think in terms of hard money, and when you're getting a hard money loan, you're going to pay an exorbitant interest rate and all of these points. How does, because I've noticed with some of the jumbo products, sometimes, especially with 20% down, your interest rate actually could be lower than what a typical conventional is. How does that work, and what do we need to know about rates?
So that's, again, why I'm at Fairway, because I have all these different avenues that I can go with jumbo products. If you fit their mold, you're going to get typically a good interest rate if you fit the mold of the product. Now, loan level pricing adjusters. So a loan level pricing adjuster is something that it adds to the interest rate, or it takes away from the interest rate if the risk of your situation is better. Some of them have to where if you're putting 60% down, you're going to get a much better interest rate. Whereas conventional, if you're at 60 or 40% down, you're going to get the best interest rate. I use jumbo products on second homes a lot.
Okay.
Because their loan level pricing adjuster is not as hard of a hit as a conventional product. And I can go, in some of the cases, I can go down as low as a loan amount of $250,000 and put them in a jumbo product as long as they fit the mold, and give them a much better interest rate than what we would see on a conventional loan.
See, I love that, because that's actually putting money back into the market's pocket rather than back into the Fed's pocket. And I'm not sitting here trying to. I don't want to get into a political debate or anything like that. But what I do
Ryan
like,
just doesn't want to get audited, so he's kissing up with the Feds right now.
yeah, look at him, okay, Uncle Sam. Look at that guy, not me. I'm on your side, okay. But what I do like that it's creating competition, and I think that when you have that healthy competition out there, whether it's mortgage-backed securities or straight up private money, when they're able to put their money into the market and size each other up based on terms and interest rates, so on and so forth. Are you seeing any of that? Do you, when you guys are doing pricing and you guys are doing your analytics, are you saying, okay, well, the jumbo product's doing this, and so the conforming product's probably going to behave this a certain way?
Well, that's what's great about having a team, because we deal with a lot of volume, so we're able to really look into products as a whole, as a team, and we always keep each other up to speed, and we're looking at different avenues to try to do the best for our customer, because we know that we're not looking for a single transaction. We're looking for a lifetime of transactions with them. But yeah, you're absolutely right. It does create competition, and we've seen a lot of that recently. When the interest rates first started to go up at the end of 2022, you started seeing a lot of the jumbo private investors back out of the market, but they've slowly started coming back, and they've slowly started coming back with more avenues, and not only on the jumbo side. And I'm sorry to switch the subject, but also in your non-QM or non-quality mortgage avenues, where we're talking about DSCR loans, where the property qualifying, and I know that's a lot of information.
A lot of acronyms.
But
My head hurts.
There's all kinds of avenues for things, and it's really cool to have these in our back pocket to use. And we've been using. We just had somebody that was a foreign national out of Australia buying a non-warrantable condo, and I have a product for it.
Wow.
Well,
I
I think that, to me, that's one of the biggest lessons. Okay, it's not a one size fits all, and just hear me out. Indulge me a little bit. I remember years and years ago, I was coaching a brand new real estate agent. She just got her license, trying to figure things out, and so I had the discussion of, how do you overcome those objections and those obstacles, when people ask you how long you've been in the business, or they know you've never sold a home. And I talked about how important it is to have a loan officer who's experienced. And so we had a discussion about who her loan officer was. She just partnered with this loan officer who just got into the business themselves. And I'm like, okay, well, who helps who? Like, what happens when we have challenges? And so, and then I transverse over to the big box banks and things like that. It's, you go to a big box bank, or you go to a loan officer who doesn't have all of those programs available to them, doesn't understand all the programs, doesn't have all the products. And then they get told by the bank, or they get told by so-and-so, well, take it or leave it. This is how it is, and it's not really a good deal. And I think with the jumbo loans, people think, okay, well, I talked to so-and-so. This must be how it is. take it or leave it. How important is that second opinion?
You know, it's a big deal. Even when it comes to conventional FHA, VA products, if you're not getting the answer that you're looking for, have a second conversation, have a third. And I'll tell you, I started off at a big box bank. It gave me the volume that I needed to learn what I was doing. People weren't looking for Justin Frederick. They were coming to see me at the bank because I worked for the bank, and they thought that I was knew everything. And literally, I was there because I was learning what I was doing. But what's funny is in a lot of situations, I use those banks' jumbo products, and I'm a correspondent lender with them.
But you know how to package the deal.
I know how to package the deal. And a lot of times, I have better pricing than the people that sit in the bank. So, which is nuts to me, and it drove me crazy when I was at the bank that I couldn't compete with somebody using my own product at Chase.
I mean, it begs a very interesting question. So, you started off at a big box bank.
Yep.
We all started somewhere, right?
Yeah.
We all were snot nosed once upon a time. How truly seasoned and quality LOs end up staying at big box banks?
It's a very small percentage, and I know a few really good LOs that are loan officers that are at big box banks, and really, I think they're just too afraid to come out of
They like the
that world.
W2.
They love that people just walk into the bank and trust the bank to do the loans.
Fair enough.
But they're dealing with all the underwriting problems and things like that. But there's a few of them, and it's very, very, very few of them.
Because I asked this because I have horror story after horror story of working with big box banks. I've had a couple of them where there was like, okay, this guy knows his way around a transaction.
It's sad, and I don't like bashing them because they got their good.
Ryan,
I don't care.
Yeah, I know you.
We're not on radio anymore, man. I can say whatever the hell I want.
Ryan will start bashing us if need be.
Give me a reason.
Most of the people that have come, most of us go to a big box bank to learn to do what we do, because there's not a class, there's not a college course for it. We learn how to do our business at a big box bank because they're going to come in and blame the big box bank for our mistakes. And that's so sad because we're talking about people's lives here and they're counting on moving into a home. But there's not a process to really teach us how to do, because every single transaction is different. It's very unique. And I know that sounds hard. It's not a car loan.
Well, and the lesson for everybody that's tuning in and listening is it's never the company behind the person, in my opinion. It is the person. Just because somebody has a big name behind them doesn't mean that they know what they're doing, doesn't mean they know how to take that car out for a spin. And if you are thinking about buying any type of real estate here in the great state of Arizona, and you've been talking with a big box bank, or you're taking a look at the loan documents and the estimates and going, boy, something just doesn't fit, or you truly just want to start that conversation and start building and putting together that strategy to building wealth through real estate, there's a reason why Justin and his team does our loans, and we want to invite you to reach out to him. So if you want to reach out to Justin, you want to get some more information, all you got to do is text the word money to 623-AZ-RECON. Again, that's 623-AZ-RECON.
Thank you for joining us on the Real Estate 401k Show. If you want more information on how to build wealth, click on the link or text us at 623-297-3266. That's 623-AZ-RECON.